Hey everyone, so in this video we'll talk about the psychology a retail investor, especially the small retail investor, should have so that they can overcome most of the wrong decisions that they take, right, while trading or investing in the market. So we'll first look at a few examples which I'm very sure that you would have done already in your trading or your investment career, and how you can avoid them in the future, right? And also, just to quote, right, like Peter Lynch and all, so they said it's not the one with the brightest mind that kind of wins this game of trading or investing, it's the one with the strongest stomach, right? So one should actually be very strong with their emotions and not let them kind of decide what they are going to do in their trading or their investment journey, right? So we'll look at 5 6 points which I'm very sure you would have done and how you can better at it, right? So first is selling a stock as soon as it comes back to your buying price. Let's say I bought Tata Motors, right? So I bought Tata Motors, let's say somewhere around 360 in January 2020. Sorry, this would be June, July, August of 2021. Let's say August or September of 2021, I bought it around 360, right? Now it kind of went down. From there, it went to level of, let's say, 300 or 280. I was staring at a 20-25% cut from there, right? So after that, the minute it kind of came back to the same level where I had bought it, right, I would be like, let me get rid of this stock. So have you guys also done the same thing in your investment journey? You buy something and then it goes down 20-25%. The minute it kind of comes back to the same level, you will be like, let me get rid of it. And the minute you get rid of it, you will feel like the stock has gone up, right? So this is like a very common mistake that most of the people do. So at the end I'll be telling you how you can kind of avoid doing this. So but this is one kind of very important thing that a lot of retail investors do. We'll look at a few more examples because most of them have a common solution, right? So this is something that most of you do, sell something as soon as it comes back in the green and then later regret it, right? So that is one point, number one. Second is not buying something which has gone above your selling price. Let's say I'm taking the same example. You sold Tata Motors at 360 and now let's say the stock price is around 500. Does your mind let you kind of buy it again at 500? For most of the traders or investors, it does not. They'll be like, they have this mental block saying that sold it at 360, I will never buy it at a higher price. If it comes back to the same level or lower, I'll think about buying. So this thing should go away, right? As a trader, you or an investor, you would be looking for opportunity. If at 400 the fundamentals are great, all right, even the technicals are extremely good, then there is no harm in buying it at a higher price. This mental block you have to get rid of in case you want to succeed in investing or trading, right? So that only comes with practice or understanding the technicals or fundamentals very deeply, right? So this over a period of time you would kind of get it in your mind that okay, even if I sold it at 360, it's okay if I buy it at 400 because now the technicals or let's say the fundamentals have become very good, right? So this is also a big mental mind block that a lot of people have, and then they end up selling their multi-baggers at a very early stage and later regret it, right? So then third one is having targets. So having targets is also another mind block, right? Why? Let's say I am of this opinion that okay, I'm going to sell CDSL only around 2000 rupees. I won't be selling it at a lower level. Let's say I bought it at 200. So it came all the way up to 1600. So at 1600, when it was kind of struggling to cross that particular level and go up, right, and started making a lower high, lower low as well, then that was a signal that okay, it is not going to 2000 immediately. I can book it now, later buy it again, right, when it starts making a higher high, higher low, like what it started doing here, right? Then it would have made sense to kind of book it at this price, re-enter at a lower level and probably whatever difference is that you would have saved it, or else you would end up buying more quantity of that same stock using the same amount, right? So never ever have targets like I will sell only if it touches 1,000. And especially these whole number targets, whenever you have, right, those are very dangerous, because usually the big guys also know that people would be willing to sell at that level. They kind of close it, or let's say start selling it just before that whole number as well, right? So never have a fixed target in your mind. If the technicals start deteriorating or fundamentals start deteriorating, it is okay to exit and book your profits as well, right? So never have fixed targets in your mind. Then fourth point, buying something because it has fallen and selling something because it has risen too much. So this is like the worst thing that you can do, right? Many people do this. So I bought something at 200. Let's say I bought CDSL at this support around 189, right? It went to like 630 and then it had a small pullback. I'll be like, I made 3x on this stock. How much higher can it go? Right? So this is like the worst thing that people can do. How much higher can it go? If the fundamentals are great, technicals are great, it can continue moving up, which it did, right? But you selling it around 600, just bagging like 3 bagger. If you had held it like up to 1600, probably you would have made 8 bagger, right? Don't sell something just because it has risen too much, right? Make sure that you look at the fundamentals and technicals. And same way with Yes Bank. Let's say Yes Bank fell from 400 to 162. Many people got in around 162. Why? It has fallen so much, it has to go up. So what it did, it from 160, it kind of bounced up to 280, but from there it was a continuous down move. Now it is somewhere around 24. Probably someone who has bought it at 10 would be like very lucky, but how many have actually bought it at 10? Many people would have bought it at 200, 150, 100, and they are staring at huge losses, right? Never blindly buy something because it has fallen. Never sell something because it has risen too much, right? Always make sure that the indicators, whatever technical indicators you are using, that is also kind of telling this or pointing at the same thing, that you have to book out or you have to kind of buy now, or the fundamentals are kind of supporting your thing, right? So if that is not there, then never blindly buy or sell something, right? Then the final one, not buying something at 52-week high and trying to buy something which is at 52-week low. I'll tell you something. So something that hits 52-week high, right? It is hitting that because big guys are pushing it, not because some small fellow is kind of buying that stock and pushing it higher. Only when these DIs, FIs, they kind of push a stock, right? Those end up hitting 52-week high. So at that point, when the big guys themselves are pushing it, as small retail investors, we should be buying it and not selling it, right? Same way something is hitting 52-week low. Why? Because the big guys are not interested in buying it, and probably because few retailers are exiting, because usually the big guys don't exit at the bottom. They would have exited usually around the top, right? Because the retail investors are getting frustrated and selling it, it is making new 52-week low. Never kind of try and buy something at 52-week low unless until the fundamentals are kind of turning around, it is showing an improvement, even the technicals are improving, then it makes sense to kind of buy it. Or else just do not blindly sell something that hits 52-week high, or buy something just because it hits 52-week low. This is the worst thing that you can do as a trader or even as an investor, right? Just because of the price movement, you can't be selling and buying stuff. So the best indicator that I use, let's say if you're a trader, you can start making use of these moving averages. So moving averages kind of tell you the momentum also. So for example, if a stock price is above the moving average, that tells that most of the people have bought it at a lower price. Now the stock price is above that level, correct? So if the stock price is above that level, high chances that there is very little selling that is going to come in, because everyone is in profit, right? If something is below this moving average, every time it kind of tries to bounce, what is going to happen? People who are stuck at higher level, they'll start exiting pressure and start selling, right? So moving averages is one thing that traders or let's say investors can make use of before taking a buy or a sell call. So usually traders take moving average 21 EMA, 50 DMA, right? Or else investors, the best ones are like 30-week moving average or 40 weeks, that is 200 daily moving average, right? So these are the ones that a trader or an investor can use for knowing that this stock is still in momentum, I can hold it. Once that is breached, you would want to reverse your decision and probably book out, right? So these are the main points. And the last one, many people buy in FOMO. So you buy when the stock is continuously moving up and sell it when it is continuously falling, right? So usually what creates FOMO? So how do these market participants, or let's say the big guys, kind of create FOMO? That is, one is very good set of results. So a very good set of results, let's say you bought something today, after it has gone up like 30% in the last 2 days, you bought it today. Why? Because yesterday it released its results and the results were extremely good, right? And after a week or 10 days, you'll see that the stock has fallen below your buying price. You'll start to wonder what is happening. Then you get frustrated, you book it out. Later, after 1 month, it kind of moves higher than your buying price, right? So what happened there is everyone bought it in FOMO, then the usual consolidation kind of happens, and then later the stock moves. So always try to buy it in consolidation or just before it is kind of breaking out, not after it has rallied like 30-40%, right? Just to make sure that you are buying it somewhere around the support and not somewhere that is too far away from a decent support, right? So FOMO is created during good results, good announcement by the management. Like let's say the management tells us that we are buying this particular company, or we are acquiring this thing, or let's say we are doing a capex, and all those kind of create FOMO in the market, wherein the stock jumps like 30-40%. If you end up buying it at after such a big rally, usually some consolidation or correction happens. So don't buy something or chase something that is already moving higher, right? And the last one is good GDP or economic data, or let's say the sales numbers come in and all of that. That kind of also creates some kind of a FOMO, wherein people would want to chase these kind of stocks, right? Fear. So there is war, or let's say geopolitical issue. So one example is in Feb of 22, when the Russia-Ukraine war happened, the small cap index cracked by 6%. But the accumulation was so strong that clearly told us that retailers were exiting, big guys were coming in. And after that, we had a 15% kind of rally from those levels before we made some kind of a top, and then distribution took place and we started falling, right? Or like the recent one. So in the recent one, there was a 10-15% correction. So in that correction, people thought everything is falling, let me sell. So those who would have sold it at that end, right, then they would be now in this thing, because they sold at a point when it was making a bottom, right? And let's say the selling price was 100 there. Now the stock price has come back to 120. Your mind will not let you buy it at those levels, right? So never let your emotions kind of determine what you're doing, because in trading the skill is hardly 10%, right? Everything else is psychology, how balanced you are, and you don't kind of give in to this fear or even FOMO, right? So hope this kind of this video helps you in taking better decisions in the coming days. And also you would have to work on it. It is not something that anyone can teach you. Only with experience you would be better at this particular thing, right? Thank you.